financial outlook of a company or person.
Exactly. It is a financial event which changes something, something of value in the business, right? So, we're going to be looking at a consulting company called Wells Consulting. That's the company we're covering in our chapter. We're following this company all the way through. We're going to do all the accounting work for this company and set up their business, right? Work through it. And till we get to, when we get through with chapter 6, we will be doing a complete real-life type simulation of setting up the company, doing their transactions for like a month. And you'll learn how to do that and complete their reports and close out their books. So we'll do the whole process for that company, a service company. So this company does accounting and consulting services. Carolyn Wells owns it. She's a CPA, and we've got an office manager, and so that means she's going to have to pay somebody, right? There's going to be some money going out to pay for the help. When it says every month the firm bills clients, what does that tell you about that company? They have accounts receivable, which means they don't make them pay cash, right? They accept.
Right, credit.
Make payments or whatever. Okay, exactly. So when you have when they have to bill their clients at the end of the month, that means they have allowed them some time to pay. So they bill them. Some of their clients may pay with cash, and we're looking at both ways. We will look at both ways of recording that kind of a transaction, and that is a transaction because we do the work, right? And when we perform services, when you go to your job and you work, and you finish your work that day, did you earn that money? Is it yours even though you don't have it in your hands yet? Yes. Same way with the business. As we complete jobs, when we complete work, they owe us the money, right? It's our money. It's ours, whether we've got the cash in our hand yet or not. So it's recognized as revenue coming into the company. Okay. That's important. And they can play, we'll take their cash if they want to pay cash, right? Oh, we'll take the cash. Yeah, all right. Okay, so what happens when we're gonna learn in this chapter how to analyze an event. So events are gonna come in the form of what? Receipts, right? Something happened, we went and bought something, we got a receipt. We made a deposit at the bank, we got a receipt. We need a paper trail for all of our transactions. We need something to prove that it happened. The auditors really want to see that, right? They want to know that the events happened. Can't just go in there and write down things. Okay, so we're going to identify whatever property it was that we either bought or used up. Then we're going to look at who owns the property. And this is to help you understand the accounting equation. Because on one side of the equation, you show what is owned by the business. And on the other side of the equation, it shows who owns it. So we're keeping in balance on you. It's going to be the assets, right? Everything that's owned is of value to the company. And there's an equal sign in the middle. And then there's who owns it. So that's what the concept that we're going to cover right now first. And we're going to look at who owns the property and is the property increasing or decreasing. All right. Then we have, here's our initial equation, the property, which we know we're calling assets, right? And it's owned by, or it equals a financial interest. Somebody has to own the property. So it's either owned by creditors who hadn't paid yet for it, right? If you have a car on this side, you hadn't paid for it yet. Who owns it? you and the bank. So somebody else has an interest in it, right? Same way with the business. All right, get on through here so we can do some of this. Okay, so here's what happens. She starts her business. She happens to have $100,000 that she takes out of her personal account. And she's going to start her business, right? Now, what's one of the basic assumptions in accounting? What does she have to do if she's going to start a business? Can she just pay taxes? Yeah. What does she have to do? Can she just go put that money in her personal account and start writing business checks? No.
Doesn't mean a business account.
She's got to open a business account. That's right. Good. So she's gonna. The business gets $100,000, right? Everybody agree? She opened a business account in the name of her consulting company, Wells Consulting. So the business got property. Who owns it?
She does.
She does, right? Because she put it in. Okay, so here's our first look at what's happening when we have a transaction. And this is all in your book too, if it's a little bit. But I just want to be able to show you because we're going to show it coming in and out of the columns. Here's our equal sign right in the middle, right? There it is. So we added cash on the asset side. So now we have cash. And on the other side of the equation, we showed who owns the cash. She still owns it. So, her name, Carolyn Wells, that's her capital or her equity, right? And she owns it. Agreed? And we stay in balance. We must always stay in balance. Okay. Can't. Every transaction has to have an equal effect, or it has to keep the
Sides balanced.
yeah, each side. What else was I going to call? This was the keep your equation in balance. Okay. All right. So here we go. Side in balance. She owns it. Buy some equipment. Then what happens? And this is important. I'm going to dwell on this just a little bit because this can be. Now, what's happened in this transaction?
She bought equipment for $5,000 and
She
credited
bought equipment for $5,000. Go ahead over there.
and credited the equipment account for $5,000.
Okay, actually, she debited it. You're talking debits, credits.
Credited cash.
She credited cash, and she's talking because she already knows that credits decrease assets and debits increase assets. You increase your asset with a debit, but we won't do that till chapter 3. But well, all you need to know now is that equipment was increased by $5,000 and cash was decreased by $5,000. So one account, we just dealt with assets, didn't we? One asset went up, the other asset went down by the same amount. So does that mean we stayed in balance? Yes. She still has the same amount of assets, right? Only it's in the form of cash. Now she has $95,000 in cash and $5,000 in equipment, right? Yeah. Now she has, well, that's the value, right? We always record purchases of assets at the cost, historical cost. And their value may not be that, like he said. Okay. All right. So we're moving right along, and now they buy. This is a good one. They buy another $6,000 worth of equipment on credit. So what happened here?
The equipment decreased or increased? Increased, and they got accounts payable for $6,000.
Right. So you increased something on the left side. You increased what? Equipment? We increased equipment. What else did we increase? And so on the other side,
We increased accounts payable.
we increased accounts payable, which increased the amount we owe to someone else. Now this changes the look of our equation just a little bit because right now now, we do have $11,000 worth of equipment in our store office. We still have $95,000 in the bank. However, on the other side, right, now Carolyn's amount is still $100,000 because she owns the 95 and the 5 that's already been paid. She paid for it, right? But the other $6,000 that's of value in the office equipment is owned by the creditors. Okay. So, we're still in balance. Our equation looks a little bit different, but we remain in balance. Now, what happens when, well, let's go, we're probably going to cover that in the next transaction. Well, we purchase supplies, that's not a, when you purchase supplies for cash, what's going to happen? Just put your supplies in, right, and take it out of cash. So it did not change the value of our assets total. Because we just paid cash, we changed cash into supplies. Okay? All right, then. Okay. You just come on. We're all.
I'm gonna pose a question.
Okay.
$95,000 cash.
Yep.
You got $95,000 cash money in the bank.
Right.
Why didn't you go put $6,000 equipment on credit?
So that y'all could learn. Right. Well, okay. Let's think about that for a minute.
Keep my cash too, but I don't want
And build credit for the company.
Maybe building some credit for your company. That was good. What else? What about, well, and like you said, cash flow could become very important at some point. And I don't know, maybe they gave it to us at 0 interest. You know? True. Would we not use it if it was free credit? Yes. Why would we use it if it was free credit? Go ahead, James. They might have gotten a better deal by financing. Who knows? What if it was free credit and you could use their money for free? You might got any ideas why you might choose to do that rather than pay cash? Okay, what else? Okay, what else? Come on, guys. Y'all can think about this. What? Let's pretend, okay, let's just, because this is true. These cash accounts are usually for businesses in interest-drawing accounts, right? For both people, for us, and for the other people. Okay. So if we're using their money free, right, and we went ahead and charged it because let's just pretend they did. They gave it to us for free. Said, you know, some of these places do 90 days, no credit. Take it. No interest, right? So if they did that, we'd be able to keep $6,000 in our account to draw interest for that long, right? Until it's time to pay them. See? It's always a yeah.
We bought $1,500.
Yes.
We added it to supplies and still kept our balance. If your supplies are being used, how will that remain?
That's a good question. That's an excellent question. And they are going to be being used. Hey, somebody over there have an answer?
No, I need to hear the question.
Oh, the question was, well, hey, if we bought $1,500 worth of supplies here, and we kept our equation in balance, but we're going to be using up those supplies, how does that work? Anybody know?
You're all the time used up, you will at any given time have $1,500 worth of supplies.
Well, no, our supplies are going to go down. They're going to go down as we use them. Anybody?
Every so often.
Yeah, that's right.